Well, the Federal Reserve kicking off its two-day policy meeting today. Investors largely expecting the FOMC to keep interest rates steady this time, but they will be watching very closely for any hints of where rates can go from here. Joining us now with what to expect, we've got Yahoo Finance's Jen Schonberger. Jen.
Good morning, Akiko. That's right. Fed officials meeting right now here in Washington in the first of their two-day policy meeting, where they're widely expected to hold interest rates steady in the range of 5.25% to 5.5%. With no new interest rate projections and no major changes to the policy statement expected, all eyes will be on Fed Chair Jay Powell for what he says in his press conference and what he guides for monetary policy. How much long-term bond yields have soared is likely to feature prominently in officials' discussions about whether another rate hike is still needed and how long the central bank will hold rates around current levels. On the one hand, inflation measured by the Fed's preferred gauge, the Personal Consumption Expenditures Index, showed inflation slowed to 3.7% in September, hitting the Fed's expectations for where inflation would end this year. That's down from 4.3% in July and around 4.6% to 4.7% for much of the first half of this year. This as bond yields have soared. All of this arguing for a pause. On the other hand, economic data have come in hot. GDP in the third quarter sizzled to nearly 5%, driven in large part by consumer spending. The employment cost index also clocking in higher than expected on wage growth this morning. All of that arguing that more might need to be done in the future. Ahead of the meeting, Powell said the central bank would proceed cautiously given uncertainties, risks, and how much the Fed has already hiked rates. But he warned that inflation is still too high and that more interest rate increases are possible if the economy or the job market stay surprisingly hot. Powell expected to continue walking that tightrope tomorrow between moving cautiously but still keeping interest rate hikes on the table to reserve optionality in the wake of hot economic data. Guys?
And we know that lag is also a part of this. So how much are the Fed's rates really hitting the economy at this point, given that consumers have low fixed rate mortgages?
Great point, Rochelle. Nearly 80% of consumers are sitting on fixed rate mortgages right now below 5%. They've got jobs, so that pertains for more spending to continue this cycle. On the other side, on the business side, you've got corporations that have financed their bonds and are sitting in low fixed rates as well for as long as 8 years. So businesses also sitting on cash. So there's a large swath of this economy that may be interest rate immune at this point, making the Fed's job of using that blunt interest rate tool more difficult. And you heard Fed Chair Powell last week say that this economy is still seeing strong demand.